Good morning, everybody. Hope you're having a good day. Gonna share with you bonds. And move a few windows around here, and we'll be good to go. Okay, so we talked just briefly about bonds in the last class, and I'm seeing some chats here, so I'm gonna may interrupt as I go. So what do we need to know about bonds? Bonds have stated rate of interest that they pay per period. Example, 6% per year. Or they'll have something like 6% per year paid 2 times a year. And so that changes it slightly, but interest is paid on face value, bonds only, although effective interest can result in a higher interest rate being paid to the buyer. Actually, can be higher or lower. Generally, companies like Standard & Poor's and Moody's rate bonds based on their risk. And bonds sell based on their risk and the interest rate they are paying. So if company X has an A-rated bond and is paying 8% of interest, and most other A-rated companies are paying 7%, company X bonds will sell for a premium. And vice versa. If paying 6%, they would sell for a discount. The premium and discount, I should say, or discount, is amortized over the life of the bond by the holder and the seller. Okay, so we're looking at this question, or these series of questions, and the information is given. Oh, hey, strange name there. Signed a $10,000 6% 10-year mortgage note to finance construction of its new hotel. Sure. Somebody asked me to scroll up real quick, so I'm just gonna leave it here as I read the first one. The note will be repaid in 10 annual installments of $1,358,679. The first payment will be made on December 31st, 2011. Okay. So what we want to do is set up a table, and I'm going to pull one from a question below. And we have a balance of $10 million. The annual payment, $1,358,679. And the interest portion is based off of the mortgage balance. So 10 million times 0.06. I'm sorry, yeah, 0.06. And that equals $600,000. So the amount of the reduction in the mortgage, we subtract that 600,000 from the 1,358,679, and that's 758,679. So then we subtract that from the 10 million. And we get our new balance. And that equals 9,241,321. So your next payment, 1,358,679. And then you're going to take the 9,241,321 and multiply that by 0.06. And I'm going to just round here. 554, 279. Excuse me, 479. Take our 1,358,000, 679. Subtract out the 554, 479. And we end up with 804, 200. And then that would come down here, 10 million. Or, I'm sorry. 9,241,321 minus the 804, 200. And that's 8,437. Oh, excuse me. $121. And then you would just sort of complete the chart, and after 10 payments, the last payment may have to be rounded or increased or decreased. All right, so I'm going to throw up the poll there, see if you have any questions. Okay. I'm going to go ahead and launch it. Then I'm going to check the chat. I see there are a couple questions there, but if you can see it, click on it for me. Okay, so I've got 2 questions. I apologize, I'm going a little quick. So I'll slow back down. And so the second part is, there's a second question that asks, why would the interest portion of the mortgage get subtracted from the annual payment? So a portion of the payment is going to be applied to interest, and a portion of it is going to reduce the mortgage payment. So if I was in Excel, I could jump through this really quick, but let's see if I can go through all the years and we'll see how that goes. Problem is the calculator is a little wonky. setting something up in Excel here. Give me 1 second. Thank you for being patient. Okay, I'm going to move over our sharing to the Excel sheet because it'll go a little quicker. Okay. So the way this works is when they get your payment, they're entitled to 6% interest on what you owed them. And so they take the $600,000 in interest, and that's their finance company's revenue. And then the rest of the payment, the $758,000, goes to reducing the mortgage and your obligation for the future. So here now we've made after our second payment. And so this is going to equal the principal payment at the beginning of the year minus what was applied to the principal. And then this will equal that balance. And then here, the million payment minus the interest. So these will be like this. And then this one. Okay. Had a question here, and they asked, how do I get the mortgage balance after the second payment? So this 8,437,000, I subtract the 852,452 from it. Okay. So okay, still a little trouble with that question. The 8,437,121 comes from this 9,241 minus this 804,200. So you see here at the end, all they would do is increase this payment by $7. And they would have no balance. And so they'd be done with their payments. Okay. All right, so let's try that poll again. See if that works. Can anybody see the poll? Oh. Okay. I don't know what's going on, but we won't stick too long on it. Does anybody have any questions? Oh, there are two questions here that I see. So someone asked, how is the annual payment derived? And it's a little bit beyond what we go into in this course, and I don't even really want you to get caught up too much in being able to do this part of it, because you don't need to. You might need to be able to calculate 1 year or one part of it, but there's a basically present value calculation and a payment calculation. Present value of $1, present value of annuity payments, and you have to multiply those out and add them together. It's a little bit beyond what we're going to be doing here, but use present value tables and you figure out how to calculate it backwards. And then someone asked, is the annual payment going to be given to us? And yes, you would need the annual payment in order to get it. So let's copy this back into the document. And I'm going to change our share back to that document. And I left the other one in there so that you can see them semi together. And we can go through and answer these questions now. So this one says, how much of the first mortgage payment was interest? And so we'd want to be here at the 6% of 10 million, so 600,000. On the test, take your beginning of the year balance multiplied by, excuse me, I'm getting a call. Uh-oh. Somebody from Buffalo. Let me see if it's somebody trying to call about the class. Hello? Oh, hey, I'm sorry, I can't talk right now. I'm working. Yeah, if you want to give me a call back in an hour, I'll be happy to help you. Is this your number? Okay, I will call you back. Thank you, Dave. Sorry. Sorry, it was this number from New York. I apologize for that. So take your beginning of the year balance, multiply it by your interest rate, and that'll give you the interest. And so here, 10 million times 0.06 equals 600,000. Okay. All right, how much of the first mortgage payment would be used to reduce the principal? And so we have 758,679. And we calculated that the interest payment, or I'm sorry, the total payment less the interest portion. So we had 1,358. $679 minus the 600,000 equals 758, 679. Okay, over the 10-year period, as each installment payment is made, the portion of the payment that is interest will. So you can take a look at this and you can type in your answer in the chat to me. Okay, so everybody got that. If we look at the interest column here, and I know you guys can't see it all, and neither can I. Wait, hold on. I can hide this ribbon. All right, get a little bit more in the picture here. So we have this interest column here. And as you can see, that is decreasing. And so for the next question, the portion of the payment that is used to reduce the principal will increase. That's the opposite. And so that's how early on it feels like a struggle when you're making these payments that made me chuckle, Spencer. You end up getting down and more of your payment goes towards the principal, and as a result, your portion of interest goes down and you owe less till you owe nothing at the end. Okay. What is the amount that it'll show on its balance sheet for mortgage payable? And it will decrease. The mortgage payable amount is here after each year. So after the second payment, after the third, fourth, fifth, etc. That's what the mortgage payment balance will be. All right. Any questions on 10 through or 7 through 11? Okay. You guys get to practice. Just do the first two parts for yourself. You don't have to do the gray. No, you don't have to type the answer to me. If you want to type what the mortgage balance is after the second payment, or I'm sorry, after the third payment, that'll be good.
I see the answers are starting to roll in. I won't leave you hanging on them. I've calculated it in Excel while you guys are waiting. Give you 1 minute for a few more people. Okay, so I think most of you got that. Take a second to look it over. Let me know if you have any questions. Type them in the chat if you do. Okay, I don't see anything, so. Okay. Only thing I'm guessing is maybe a rounding issue. You're only $40 off. Okay. Part B, show the effect on the accounting equation. So we borrow $100,000. That increases our cash by $100,000. But we also have $100,000 liability, and I think they said this was a mortgage. All right. December 31st, 2011, make the first loan payment. So 10,955 reduces cash. Your liability decreases by the 1,955. And in retained earnings, you have an expense of 9,000 for interest expense. The second loan payment, you have a reduction of 10,955 in cash. Sorry, this is supposed to be mortgage. And then here, 2,131 mortgage. And then your interest here, 8,824 interest expense. Okay. This is a pretty straightforward one. The answers will be out there. You can practice that one.
Someone asked me to scroll back up. Okay. The other ones there, 7 through 18, are all practice as well. All right, you're familiar with the debt to equity ratio, and then I have a little matching exercise. So on these questions, don't get caught up on making the big chart like I've made for both of them. It's not bad practice, especially if you're going on, you're going to be finance or accounting. The amortization tables are useful. What you want to focus on is the concepts in the chapter. And so I'm going to find a couple here. 7 through 18, the IOU Corporation issued 8% bonds at 98. And so that means that the company sold bonds at 98% of their face value. So that equals 100,000 times 0.98 or $98,000 is what they received. So these bonds sold at a discount. We talked about this from up above. These bonds sold at 98 because the stated interest rate was higher than the market rate of interest. No, the stated interest rate was lower than the market rate of interest. And that's correct. All right. How much cash did the bonds or did the company receive when the bonds were issued? 98,000. How much cash will the bondholders receive on their first payment date? So remember, your payment is still going to be based off of your face value. So they had $100,000 principal times the 8%. And so that will be $8,000. Okay. How much cash will the bondholders receive? And it says, assume that the final payment of interest has already been made separately. And so it says the bonds pay interest annually and they're 10-year bonds. So in this case, they're only paying interest, so they have to pay off the bond payment at the end, and that's $100,000. Okay, any questions? Yeah, there'll be class on Friday. I'll answer any questions on chapter 7, and then we'll start chapter 8. Your reading quiz will not be until Monday, though. Oh, is that a normal holiday for us? I don't know. My last university didn't have it as a holiday. Let me look. I'm away from the chat from 1 second, so I can't see it, so hold on. Correct, no classes. I apologize. That's good timing then. All right, so back to the chat. No class on Friday. I apologize. Somebody's asking me to scroll up to number 13. I didn't do number 13, so I skipped over that. The answers will be available on Saturday for you to take a look at them if you want to practice them, and you won't need it to do your practice work. All right. Any other questions? I know we're 2 minutes over. I apologize. You guys have a great Friday and good weekend. And I think I said that backwards. Good Friday and great weekend. And I will see you on Monday. What question do you have? Oh, Part C. Yeah, I left that one incomplete as well. I feel like you guys can fill that one out on 12 on your own, Juliana. And the answer will be out there. Did you have any questions, Sarah?